This is Peter Gaylord. I'm the CEO of Gaylord and Belinsky Wealth Management. In today's video, we're going to talk a bit about the history of the bond market over the last 30 years or so. During that time, we saw an unprecedented get that word out, bull market in fixed income. Now I'm going to take a bit of a break here from the video, show you a slide that will show you what's happened with yields over the last few decades. And when we come back, we'll have a bit of commentary on it. Thanks. Well, I hope you enjoyed that slide, or at least found it to be informative. There's a few observations that we can make from it, and these are relevant to what's happened with the fixed income market over the last 3 decades, and to put things in perspective to consider where the bond market's going to be going in the future. Now, the first thing that you probably noticed on that slide was the peak that occurred back in 1981. On September 30, 1981, the 10-year U.S. Treasury peaked at a yield of 15.84%, quite remarkable in light of the fact of where interest rates are today. And the key reason for that is we had a Fed Chairman, Paul Volcker, who was determined to break the back of inflation. As some of you may recall, whether you're old enough to remember it or know a little bit about market history, we had quite a problem with inflation in the 1970s. And Paul Volcker came in as Fed Chairman in the late 70s and was determined to wipe out inflation in the U.S. economy. And the way he did that was to consistently raise rates on the Federal Reserve's interest rates. And what that did is it drove up yields to the point where it really slowed down the economy and slowed down inflation, eliminated it as an issue. And at the time it was quite controversial because it did have a negative impact on jobs and unemployment rates and so on. But ultimately it was successful in eliminating inflation from the U.S. economy. Now what we saw ensue over the 30 years after that was probably one of the greatest bull markets in history in fixed income, where yields consistently came down. And a big reason for that being the fact that inflation for much of that period became essentially a non-issue in the economy. It wasn't something most people worried about the way they did back in the 70s and other periods in the past. And over that 30-year period, we saw the rate on the 10-year Treasury, the yield, go from the 15.84% peak that we saw on September 30, 1981, until it went down very low. And as of December 31st of 2012, we saw that yield go down to 1.76%, very dramatically low. And that was really important because in an earlier video we talked a bit about the basics of investing in bonds and the subject of price and yield and how those two move inversely. So as we saw interest rates, yields coming down for about a 30-year period, the value of bonds and bond portfolios in fixed income instruments consistently went up. We had a huge boom in fixed income. And the key thing to take into account here is that for most investors, that's the only environment they've ever known when it comes to investing in fixed income. So without taking really a great amount of risk, at least at that point in time, people were able to buy a bond portfolio, earn very good yields generally, and they kept seeing the value of their bond or bond portfolio, ETF or mutual fund, whatever they invested in, consistently going up because yields were falling over that 30-year period. So most people take that as an indication that, gee, bonds are a safe investment, I earn good yield from it, they keep going up in value, this is a great thing. Now, unfortunately, the environment recently has changed. We saw in May, particularly around the May 2013 timeframe, interest rates suddenly spike up. And one of the key reasons for that is that there's a fear of what's called the tapering by the Fed. The Fed's been doing a lot of quantitative easing and efforts in the past few years to stimulate the economy after the financial crisis of 2008 and the tepid economy we've seen since then. And they've been doing that in a variety of ways, one of which is to inject a lot of cash into the economy through various measures that we won't go into here. But in any event, it now looks as if the Fed will eventually stop doing some of the measures that they have been doing, the quantitative easing, and longer term we expect to see rates go up again. Typically 10-year treasuries are in the range of 5 or 6%. And so with yields that had been down around 1.7, 1.8% on the 10-year treasury, we know that's really an unsustainable situation. And around the May 2013 timeframe, when it looked as if some of that quantitative easing was going to end, we saw a huge rise, or a very rapid rise, in interest rates where the 10-year went up about 100 basis points, 1%, in a very short time frame. And that caused a lot of losses for a lot of people in their fixed income. So the key takeaway we have here is that many people throughout their investing lifetime have seen nothing but a very favorable environment, and unfortunately that environment's now coming to an end. So when you're looking at investing, you really need to have a sense of where interest rates are going forward, and unfortunately that's probably up. We can pretty much safely assume that at this point. So I hope that history of the bond market has been helpful. I'm going to put the slide up here again at the end, and then you'll see a closing slide that has our contact information. If you'd like to talk about bond investing or any other subject, please contact us. We've put our contact information in the comments below on this video. You can follow us on this YouTube channel, Gaylord Belinsky, or you can follow us on Twitter at Gaylord Belinsky. So I hope you find our videos and tweets and other information to be helpful, and if you need assistance with your investing, please be in touch with us. Thanks.